Welcome to This Explainer. You know, when we talk about financial powerhouses, everyone always points to the stock market, right? But what if the world's most powerful financial market is actually one that most people never even notice? Think about it. Every war, every welfare program, highway, hospital, currency, and inflation cycle all begin in the exact same hidden place, the bond market.
While all the flashy headlines are obsessing over stocks, governments are quietly borrowing trillions of dollars. Central banks are obsessively watching bond yields, and investors are moving massive amounts of capital across continents. They are quietly influencing interest rates, currencies, and literally the future of entire economies. It brings up a really surprising question. Who actually controls the global economy? Is it the governments making the decisions or the bond markets financing them? As these invisible rivers of capital connect nations, banks, investors, and financial institutions, one extraordinary realization emerges. This isn't just another financial market. It is the invisible force that quietly shapes modern civilization. By the end of this explainer, I promise you will never look at governments, inflation, or the global economy the same way again.
But before we dive in, please note, this video on the channel Blocks Bonds Funds is created for educational and informational purposes only and does not constitute financial or investment advice. All right, let's get into it. Section 1. The Invisible Financial Engine. To really wrap our heads around the sheer power of this system, we first have to grasp its absolute mind-bending scale. $133 trillion. In 2022, that was the total value of the global bond market. Out of that massive pool, the United States market alone was valued at $51 trillion, representing about 38% of the entire market. And listen, this isn't just money sitting in a vault somewhere. This represents the baseline for global borrowing costs. This is the financial foundation of the world, quietly dictating how expensive it's going to be to build a home, start a business, or even run a country. Moving to Section 2, how governments actually borrow. So, how do governments actually pull this off? How do they transform future tax revenue into capital they can use today? Well, when a government faces a budget deficit, instead of just relying on taxes or printing money, it issues government bonds. Basically, it's asking for a loan. Through bond auctions, they offer these bonds to a massive global secondary market. We're talking banks, pension funds, insurance companies, central banks, and global investors all stepping up to purchase this debt. This is exactly how a government takes a promise of future tax revenue and transforms it into today's infrastructure, healthcare, defense, and public investment. Right at the center of this whole ecosystem is a specialized group of buyers known as primary dealers. These institutions, mostly banks and broker-dealers, form the Layer 1 architecture of the market. They are mandated to participate in these auctions, and their absolute most important job is to quote two-way prices. Why? To ensure constant liquidity. They absorb the debt, distribute it globally, and create a system where sovereign bonds emerge as the fundamental financial foundation linking governments with investors worldwide. The debt is seamlessly issued, traded, and refinanced. Which brings us to Section 3. Yields, the market's voice. Okay, so how do we know what all this debt is actually worth? That brings us to yields. If bonds are the invisible river of capital, yields are the market's voice speaking to us. It's really essential to understand the inverse relationship here between bond prices and bond yields. Think of it like a seesaw. When interest rates fall, newly issued bonds pay less, making older, higher-paying bonds way more valuable. So their prices rise. But because they are now more expensive to buy, their overall yield, the actual percentage return for a new buyer, drops. Conversely, when interest rates rise, bond prices fall, and yields adjust upwards to reflect expectations about inflation, growth, and future interest rates. Now, when you chart those yields across different maturities, you get the yield curve. This animated curve reveals how millions of global investors collectively evaluate the future of entire economies. Are we going to see inflation? Will there be growth? The effects of this curve ripple through literally every layer of society. Mortgage rates, corporate borrowing, major infrastructure projects, business investment, and everyday consumer credit. They all respond directly to these government bond yields. The bond market quietly influences nearly every major financing decision you make. Let's look at Section 4, Financing Modern Civilization. You know, this modern architecture didn't just appear out of thin air. It financed the defining moments of modern civilization. History unfolds through wars and nation building. It actually started back in the American Civil War, when a banker named J. Cook created a nationwide network to sell small denomination bonds directly to ordinary households, completely bypassing the usual elite bank syndicates.
By World War I, this had evolved into the Liberty loans, which raised over $17 billion. And then we hit the absolute peak. World War II Series E bonds. 85 million Americans bought these bonds, raising an astonishing $185.7 billion. These war bonds financed massive military campaigns, essentially training everyday citizens to become capital providers.
And the legacy of that public funding? It absolutely continues today, financing the infrastructure of your own community. Municipal and tax-exempt bonds, along with sovereign borrowing, are the concrete tools used to fund massive public projects. We're talking highways, hospitals, railways, schools, welfare systems, and renewable energy grids. By spreading the cost out over a 20 to 30-year lifespan, investors get tax-free interest and the community gets its infrastructure. It's this brilliant intergovernmental partnership that quite literally builds the country.
Of course, the tools for this financing are constantly evolving to manage risk, especially when inflation enters the picture. As purchasing power declines, investors naturally demand higher returns. The introduction of zero-coupon and inflation-indexed bonds in the late 90s offered a much-needed shield. These instruments provide a fixed real yield, protecting long-term investors, like pension funds, from unexpected spikes. Because they are so sensitive to these shifts, inflation expectations, real yields, and inflation-linked bonds demonstrate exactly why bond markets often anticipate economic changes long before they reach everyday life.
But let's look at what happens when things go wrong in Section 5, when confidence actually breaks.
What actually happens when that confidence weakens and the system breaks? Modern civilization relies on smooth markets. Capital flows constantly across the United States, Europe, the United Kingdom, Japan, India, and other major economies. Exchange rates shift as investors seek safety and returns. But nations that rely heavily on external debt, meaning borrowing in a foreign currency, become incredibly vulnerable. If their local currency drops, their repayment costs absolutely skyrocket. When investors start selling government bonds en masse, yields surge, borrowing costs rise, and severe financial stress spreads rapidly through the domestic economy.
Understanding the exact mechanisms of these breakdowns is absolutely critical. For starters, unexpected inflation silently devalues existing debt. Then there's the hidden rollover risk in the derivatives market, with short-term foreign exchange swaps reaching a staggering $130 trillion. When market conditions freeze up, historical debt crises illustrate just how quickly markets will discipline governments when fiscal credibility declines. Central banks are forced to respond through open market operations and liquidity support. Giant institutions like the Federal Reserve, the European Central Bank, the Bank of England, the Bank of Japan, and the Reserve Bank of India step in with quantitative easing to guide financial conditions. But remember this, they influence the global bond market, they never fully control it.
Let's pull it all together in Section 6, the Global Planetary Network.
Let's zoom out here for a second to see how all these puzzle pieces connect. Governments aren't just thinking about today, they're actively modeling decades into the future. By running debt simulations stretching all the way to 2050, they factor in GDP growth, tax revenues, and multi-decade challenges like an aging population and climate change. To manage this safely, governments utilize tools like sinking funds, capturing compounding returns to systematically fund their future debt servicing. It's a highly calculated multi-decade balancing act. And so, the complete architecture assembles into a true planetary financial network. It's an integrated system linking governments, investors, banks, pension funds, corporations, households, and central banks. Invisible streams of debt capital flow across borders, financing infrastructure, technology, healthcare, defense, and economic growth. Governments issue the debt, central banks attempt to stabilize the liquidity, and global investors allocate the capital. This interconnected ecosystem reveals the bond market for what it truly is, civilization's financial backbone.
Which leaves us with one pretty profound realization. As we reach planetary scale, you can picture glowing rivers of sovereign and corporate bonds connecting every major financial center. The bond market is just far, far more than a marketplace for debt. It finances governments, influences inflation, stabilizes currencies, allocates global capital, and quietly shapes the destiny of entire nations. As we pull back and look at the whole picture, one final realization remains. Modern civilization is built not simply on money, but on trust. Trust expressed through the global bond market. So, what happens when that trust runs out?